This is the reason a Brazilian study found that 97% of day traders who stuck with it for more than 300 days lost money, while a separate, widely repeated Fidelity story claims their best performing accounts belonged to people who had either died or forgotten the accounts existed. Today we're breaking down the real difference between trading and investing, because if you are somewhere between 45 and 65 with serious money on the line, the version of this answer you've been told is incomplete. And the part nobody talks about is the part that quietly decides whether you build wealth or slowly bleed it out. Let's start with what most people will tell you, because we have to get past it before we can get to the real answer. Ask 10 people what separates trading from investing, and 9 of them will give you the same single word, which is time. Investors hold for years, traders hold for minutes, days, or maybe months, and that answer is technically correct as far as it goes. Investopedia defines investing as a long-term, buy-and-hold approach focused on building wealth gradually, usually for goals like retirement, while trading is the active buying and selling of stocks, options, futures, or anything else, based on anticipated short-term price movements. Here is where it gets more interesting. The IRS, which matters quite a lot if you are in your 50s or 60s with a real portfolio, does not actually care what you call yourself. Under IRS Topic 429, qualifying as a trader in securities for tax purposes requires meeting 3 specific tests, which are seeking to profit from daily market movements rather than from dividends, interest, or long-term appreciation, conducting activity that is substantial, and carrying it on with continuity and regularity. The line directly from the IRS reads as follows: "It doesn't matter whether you call yourself a trader or a day trader, you're an investor for federal income tax purposes, unless you actually meet those criteria." Right there, the government has already drawn the line for us. An investor expects to earn money from the asset itself, meaning the dividend, the interest, or the long-term growth of the business. A trader, by comparison, is trying to extract money from the price action. That one distinction, owning the business versus betting on the price, is where the real difference lives. Benjamin Graham, the man Warren Buffett calls his teacher, wrote it down almost a century ago. In The Intelligent Investor, Graham defined an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Then came the line that has been quoted 1,000 times since, which is, people who invest make money for themselves, people who speculate make money for their brokers. Buffett built on that foundation. Asked about the difference, Buffett has essentially explained that a speculator isn't really paying attention to what the company is doing, because the speculator is paying attention to what the next person is going to pay for it. That is the dividing line. Investing concerns the asset itself, while trading concerns the next buyer. This is where the real-world evidence gets uncomfortable. There is an academic paper by 3 researchers, Shag, DeLasso, and Giovanetti, published through SSRN under the title, "Day Trading for a Living." They examined every individual in Brazil who traded equity futures and stuck with it for more than 300 days, and 97% of them lost money. Only 1.1% earned more than the Brazilian minimum wage. Only 0.4% earned more than $54 a day, which is roughly what a bank teller pulls in, and the single top earner across the entire study made $310 a day while taking on extreme risk to do it. CNBC ran the story in November of 2020 under the headline, "Attention Robinhood power users, most day traders lose money." This pattern isn't limited to Brazil. Researchers Barber, Lee, Liu, and Odian at UC Berkeley conducted similar studies in Taiwan. And what they found was that the aggregate trading losses of individual Taiwanese investors equaled roughly 2.2% of Taiwan's GDP, which is almost 3 times what Americans lose at gambling. State securities regulators here in the U.S., through NASA, cited research by Ronald Johnson, concluding that 70% of public traders, in his words, will not only lose, but will almost certainly lose everything they invest. Compare that picture to the other side of the ledger. The S&P 500, going back roughly 150 years, has returned an average of about 9.4% per year, with dividends reinvested. Between 1993 and 2025, 26 out of 33 years, which works out to 79% of them, ended as positive years for the index. You didn't have to be smart, you didn't have to time anything. You simply had to be there. This is where that Fidelity story comes back in. Cited by Business Insider in 2014, by Morningstar's John Reckenthaler, and by hedge fund manager Monish Pabrai in his public talks. The story goes that Fidelity looked at which of their accounts performed the best, and the answer turned out to be the accounts belonging to investors who had either died or forgotten the account existed. To be fair, Fidelity has never officially published this study, so treat it as a widely repeated anecdote rather than a peer-reviewed finding. The reason it's spread is that it lines up almost perfectly with what Dalbar has been measuring for 32 years through their quantitative analysis of investor behavior report, which year after year shows the average investor underperforming the very index they're invested in, not because the market failed them, but because they bought and sold at the wrong moments. The real difference between trading and investing isn't time, it is what you're betting on, and who is most likely to win that bet. Let's get into the part that matters specifically for you if you are in your 50s or 60s and trying to figure out where your money should sit, which means taxes. In 2025, holding an asset for more than 1 year and then selling triggers long-term capital gains rates of 0%, 15%, or 20, depending on your income. For a single filer in 2025, the 0% rate runs up to $48,350 of income. The 15% rate runs from there up to $533,400, and the 20% rate kicks in above that. For married filing jointly, the 0% bracket extends to $96,700, while the 15% bracket stretches all the way up to $600,050. And higher earners may owe an additional 3.8% net investment income tax on top. Sell that same asset before you've held it a full year, and the IRS taxes you at ordinary income rates, which currently top out at 37% federally. That is a massive penalty for short-term thinking baked directly into the U.S. tax code on purpose. The government is literally paying you to be patient. One more wrinkle deserves attention. Qualifying as a trader in securities under those IRS rules opens the door to what is called a Section 475F Mark II market election, which converts your gains and losses to ordinary income, exempts you from the wash sale rule, and removes capital loss limits. Filing that election has to happen by the due date of the prior year's tax return, without extensions, and missing the deadline means waiting another full year. Here is the bigger picture. A chart that has circulated widely, drawn from data on the New York Stock Exchange, shows that the average holding period for a stock peaked in the late 1950s at around 8 years. By June of 2020, according to the World Economic Forum, that holding period had collapsed to roughly 5.5 months. We are collectively less patient than any generation of investors in modern history, and the entire infrastructure has been engineered to keep us that way. Starting with commission. Free trades in October of 2019, when Schwab eliminated commissions and the rest of the industry followed within days. Then mobile apps, fractional shares, options on your phone, and crypto trading 24 hours a day. The line between investing and speculating has been deliberately blurred, because there is enormous money in convincing you to trade more often. The research keeps reaching the same conclusion. SPIVA scorecard data from S&P Dow Jones Indices, published continuously since 2002, consistently shows that the vast majority of professional active managers, people whose entire job is beating the market, underperform their benchmark index over 10 and 20-year periods. If the pros can't reliably beat the index, The math for the rest of us doing it on a phone after dinner gets pretty grim. Here is the bottom line, and this is what I want you to actually take with you. The real difference between trading and investing isn't the clock, it is the source of the return. Investors get paid by the asset itself, meaning the dividends, the interest, and the compounding growth of a real business over decades, while traders get paid by the next buyer, which means somebody has to be wrong for them to be right. And the data keeps saying that somebody is usually them. The tax code knows the difference. The IRS knows the difference. Graham knew it back in 1949. Buffett knows it now. And those Fidelity accounts that performed the best did so for the simple reason that nobody touched them. None of this means you can never trade. Plenty of people, as Investopedia points out, end up running a hybrid approach, with a core long-term portfolio and a smaller separate slice carved out for active trading if their temperament demands it. For the wealth you actually need, though, meaning the retirement money, the security, the dollars you cannot afford to be wrong about, the evidence has been pointing in the same direction for almost 100 years. Time in the market, not timing the market. Own the asset, don't bet on the buyer. Let compounding do the thing it was designed to do. That is the real difference, and now you actually know it.